Before we continue, subscribe to understand the future of markets.
All right, let's dive right in. Today we're looking at something pretty incredible where Wall Street meets Silicon Valley, a brand new strategy called deep hedging. We're going to break down how researchers are teaching an AI to handle the kind of financial risk that has kept traders up at night for decades. This is fascinating stuff. So let's just put ourselves in the shoes of a big bank for a second. You've sold an options contract. What does that mean? It means you've promised to buy or sell something at a certain price down the road. You're on the hook. And if the market goes haywire, your potential losses are huge. So the million-dollar question is, how do you keep from getting wiped out? And that brings us to what's known as the high-stakes game of hedging. Selling that option is kind of like stepping on one side of a giant balancing scale. Your job is to keep it perfectly level. The only problem is this scale is sitting in the middle of a hurricane. Every gust of wind is the market moving, and it threatens to send the whole thing crashing down. At its heart, the idea behind hedging is actually pretty straightforward. You just want to make your portfolio completely immune to those wild market swings. You took on a risk when you sold the option, so now you have to make other trades to cancel it out perfectly. You're basically trying to build a financial fortress that can withstand any storm. So how has this been done for the past, half a century? Well, the answer comes down to one classic, fundamental tool that every finance pro knows. It's called delta. Delta is part of a whole toolkit of risk measures that traders call the Greeks. And the easiest way to think about delta is as the options price speedometer. It tells you, for every $1 move in a stock, how much your options price is going to change. It's a measure of sensitivity. Now check this out, because delta isn't a static number. If your option is at the money, right at the current market price, its delta is about 0.5. So a dollar move in the stock means a 50-cent move in the option. But as that option gets more and more in the money, its delta creeps up towards 1, where it starts moving lockstep dollar for dollar with the stock itself. And this is what leads to the classic textbook strategy, delta hedging. The whole goal is to get to a state called delta neutral. So if your option has a delta of 0.50, you simply go out and buy 50 shares of the stock to perfectly offset it. And boom, in theory, your portfolio is now perfectly balanced. It shouldn't budge an inch, even if the market moves a little. Sounds perfect, doesn't it? A nice, clean formula to make risk just disappear. But as we all know, the real world is messy, and that elegant theory crashes headfirst into some very real and very expensive problems. These problems are called frictions. First up, you got transaction costs. Every single time you buy or sell stock to adjust your hedge, you're paying a fee. Second, and this is a big one, you can't rebalance all the time. The theory assumes you're adjusting your hedge every single microsecond, but in the real world, you might only do it once a day. And all these little frictions, they create something called hedging error. It's that gap between the perfect world on paper and what you can actually do. And these little gaps, they add up. They can lead to some really nasty, unexpected losses. And this is the exact problem that researchers are now pointing an AI at. Okay, so this is where the story takes a sharp turn into the future. Instead of trying to patch up the old formulas, researchers just decided, hey, what if we taught an AI to play this game from scratch and see if it can figure out a better way? The technology they're using is called reinforcement learning, and honestly, the best way to wrap your head around it is to imagine teaching an AI to play a video game. A very, very high-stakes video game, where the board is the financial market, and the goal is to get the highest score by minimizing your risk until the game ends. So how does it actually get smart? It's a really powerful loop. First, the AI tries something. It decides to buy or sell some shares. Then, it looks at the result. Did it make money or lose money? Based on that feedback, it tweaks its strategy, just a little. And the key is, it does this millions and millions of times across all kinds of simulated market conditions, until it discovers a strategy that consistently beats the old way of doing things. But here's the thing. To be a true grandmaster at this game, the AI needs more than just the current price. It needs a little glimpse into the future. And this is the secret weapon, the thing that really makes deep hedging so powerful. It all comes down to the data. See, instead of just letting the AI see the stock price, the researchers gave it access to this incredibly rich, forward-looking data set. It's called the implied volatility surface, and giving it this data is like giving a chess player the ability to see 10 moves ahead. So what in the world is an IV surface? Just think of it like a weather map for the stock market. It's a 3D chart that shows what the entire market, all the traders, all the banks, everyone, collectively thinks is going to happen next. It's a forecast for future price swings, a map of the market's hopes and fears. And look at the level of detail the AI is picking up on. It's not just one number. It's learning to read the entire shape of this map. It understands the slopes, the curves, and even these subtle features that traders call the smile or the smirk, which can signal that the market is really scared of a sudden crash. Okay, the theory is really cool, but does this fancy AI agent actually do a better job when the rubber meets the road? Well, the researchers ran the numbers, and the results are pretty jaw-dropping. Take a look at this chart. It's from a backtest on real historical data. The bars show a risk metric called CVAR. Just think of it as a measurement of how bad your worst-case losses could be. So a lower bar is much better. As you can see, the old-school Delta hedge has a risk score of over 2.1. But the AI agent, it comes in at just under 1.8. That is a huge reduction in catastrophic risk. And that wasn't just a lucky run. Across all their simulations, they found that on average, the AI agents cut downside risk by a whopping 38%. 38%! That is a massive improvement over the classic strategy. But this is what I find really incredible. Remember those real-world frictions like transaction costs? Well, look what happens when you factor them in. As trading gets more expensive, the traditional Delta hedge gets way riskier. But the AI's advantage actually gets bigger. It's not just better, it's smarter and way more efficient in the real world. So what's the big takeaway here? The AI isn't just following a formula better than a human. It has actually learned that trading has a cost. It's figured out on its own how to make fewer but much smarter trades to balance both the market risk and the costs of hedging. It has developed a genuinely superior strategy. I mean, this technology is already proving it can beat decades of human financial theory at one of its most fundamental challenges. It just leaves you with this one big question. If AI can learn to master something this complex, what is it going to learn to do next?